because I actually don't contribute to Kiwisaver anymore, but at all.
For the $1,000?
No, I don't. I have two businesses.
Yep.
This being one, I have to back this business and its ability to 10x.
Welcome to Slice, Property Made Possible. We're a platform on a mission to reduce barriers to home ownership. This podcast is a safe space for our community to learn together and build the confidence required to start on their property journey. When you're ready to start, head along to slicetobuy.com and sign up for your free dashboard.
Alrighty, welcome back to another episode of Slice Your Property podcast. Today we're joined by Dean from Kernel Investments. Hi, Dean.
Morning.
As we were talking off camera there a little bit about your experience, I would actually like to kick us off there and just hear a little bit about what led to Kernel.
Yeah, so I studied finance at Canterbury University, left there, moved to Wellington actually after the crashes quakes, so right type year out of there, and ended up getting a job working at NZX Stock Exchange. So I did about 7 and a bit years working at the exchange, originally starting within the energy team. And during that career progression, I was always very vocal around saying, look, I'm getting a bit bored in a role now, I want to stretch myself. And I encourage a lot of people to put their hand up when they're at that stage, rather than, I think a lot of people jump ship and just leave rather than kind of see what opportunities may come up. So I didn't really know where I wanted to go career-wise, but by chance got involved in the team that had a company called SmartShares. So we ran ETFs, exchange traded funds. And there was just 5 of us and 5 in the team, 5 funds, and ended up spending about 4 years working in that team as we launched a bunch of ETFs, acquired another business. And then after about 7 odd years, I'd sort of done with the corporate sort of world there and couldn't really see where I wanted to go next within it. We were always doing interesting things, but we were sort of constrained by technology. It was a lot of legacy sort of
That's what we're talking about.
When you've got old technology, like financial services, like, as you'll know, banking background, like there is a lot of old tech. And
it's just a spaghetti warehouse of tech back there.
And people really get trade as digital banks, but there is a lot of manual old systems behind the scenes. And so it was a chance to actually go, well, if you're going to design it from scratch today, how would you actually design it? So we basically went out and said, this is how we should build it. This is what's going to be best for the customer, and really put the customer first in what we did. And so that sort of led to Kernel.
It's amazing to hear. And I am keen to kind of jump into a little bit of, what that journey can look like for people in shares. But before we do like to ask everyone that comes on the show about their first home buyer experience. So can you tell me a little bit about your first home?
First home was a workman's cottage in Wellington, central Wellington, and it was back in the days when you could get 5% deposits.
Nice. Actually, those days are back.
Yeah.
They're coming back in.
So that's sort of the context. I think like it's astounding to think like I was 22 years old and had a $20-something thousand deposit and bought a $380,000 house.
Yeah. The challenge is, even if it's 5% now, it's like still $60,000 or something that you might need.
Exactly,
like it's a larger.
Exactly. So Wellington property prices have been flat for a long period of time, and so nothing was really happening. And it was a slightly run down, but bit of character workman's cottage. Like first home, great. So $20,000 and you could buy a house. And so that part was all good. And in hindsight, a little bit, I wish I'd bought 20 of them. But the first home experience was actually a little stressful because we were kind of given a pre-approval by what at the time was National Bank.
The horse and everything. I'm still with ANZ and I feel like I'm there because of the horse. They should bring the horse back.
I know, they were great ads.
Yeah.
The National Bank, but they weren't so great when it came to it because they declined us after we'd signed the agreement. And so it was, and I can't remember what it was to do with like a late payment on a credit card. Like we were talking about a $500 credit card, not like a $10,000 credit card. And so then it is, you're 22 years old, you need to settle your house in like 2 days. And it was like, what the hell do we do?
I don't think the bank would do that nowadays either, though. So it's like, things are different. While you got away with some things, you didn't get away with like sort of impractical things like that.
But managed Kiwibank would save the day.
Oh.
And so that was basically whoever would give us a loan was the bank we were going to be with, and we managed to get there and got first home.
Nice. And in terms of, I guess, Kernel, how were shares a part of your investment journey?
So I still bought some shares, particularly when I was working in exchange, right? So it was a part of the conversation, and we'd often have after work drinks with the big brokers, and sort of, back then Zero had just listed, so there was some exciting things going on in the exchange. We had the listings of the power company. So it was actually a much more entertaining time for New Zealand stock market than it is today. And so I bought a few different shares, just small amounts. But obviously the irony was I started working in an index fund business, and I do look back and ran the numbers and I really wish I'd taken my own advice today of if I'd just gone into the ETF, I would have had much better returns than picking some of those stocks. So got involved from very early on, and found that it's a good way to sort of build up wealth outside of the house, particularly if we were saving for a renovation or other things, right? And so that was always a part of it, and I got also quite passionate about the sector and indexing and building good investment outcomes. And so for us, it was always about investment outcomes and creating a better means to be able to do that.
Yeah. And so you say today, like now you would recommend going into an index fund. Do you want to just dive into that in a little bit more detail?
Yeah. So when it comes to say your Kiwisaver, right, which is a big part of somebody's first home purchase, there are kind of effectively two different styles of investment management approach when it comes to a Kiwisaver. On one end of the spectrum is an active manager who tries to pick stocks and pick times of the market, and the other is an index fund that simply owns the market and it's sort of more data systematic. And so we lean on that side of the spectrum.
So that would be like your S&P 500 kind of thing. Yeah.
So the index is a calculation, and it just basically measures the performance of the 500 biggest companies. And all that fund does is rather than employ a bunch of people trying to pick stocks, it just holds those companies and those weights. We do have some active management, like with our cash and how we do it within the balance, but I guess we view ourselves as being very data and systematic. So we look for data and facts. That determines our views of the world. And so that's gone down the indexing approach, but we also try and we've always been from day one, people focus on management fees, you should be looking at fees that eat into your returns, but there are other costs when it comes to investing. And it's probably no different buying a house, right? There are a lot of other things that eat into it and other costs that people need to be conscious of. And so things like tax. And so we really wanted to solve make sure there was no tax was as optimized and least tax leakage as possible, no transaction fees, all that other.
Yeah, I'm really keen to talk about fees because I think that's a big challenge for a lot of people that maybe don't know where their Kiwisaver is, for example, or how it's performing. And quite often the fees can be the difference, not actually how the shares are performing.
Yeah. So this is kind of what's driven what's called the active versus passive debate, right? So globally now, about 40% of the US market is now held in index funds. And actually, when it comes to funds managed in the US, there is now more money in index funds than active funds. People have been moving because the data is showing that the majority of actively managed funds underperform, 9 and 10 will underperform, 9.5 and 10 actually underperform over sort of a 10-year period. And so people have been moving towards index funds. We were actually really ahead of the curve here. So Smart Shares, where I started at, ETFs in New Zealand have been around since 1996. We were 5 years ahead of Australia. But now Australia, that indexing space is significantly bigger than it is in New Zealand. Kind of flew under the radar for quite a while here, but now people are realizing actually there are more options and fees matter. I guess there's been sort of a personal finance revolution or sort of awakening over the last few years that people are going, right, where is my Kiwisaver? What am I paying? What is index investing? And they are learning and they're making better decisions.
In a sense, the customer has to be more active in their approach as opposed to, hiring someone who's going to be active for you. It's more like looking at the fees, looking at, the terms.
What we find that's really interesting is 40% say of our customers have an automated investment plan. So a lot of our customers they're making the decisions, they're going, this is for me. And they are putting their spare cash to work because they're trying to build it up for whatever that next
could be a house deposit, even
retirement, etc. So for us, the other metrics we're really excited about is seeing people actively building wealth, and the focus is about their habits. It's not trying to pick a stock or time the market. They know they're investing into the share market and they're doing it as really efficiently as possible. So it's about creating habits and helping people stick to the course around regularly.
And actually educating them around, good habits and what to do. What's really interesting is the fact that, that there has been that change and that drive towards index funds. I suppose it's probably come with the data revolution, like the more data, the insights that are available, because back in the day, we were just cowboys being on the stock exchange, just being like, I'm going to put like 100,000 a bit on that or whatever it was. And now you can't rely on the hunch so much. And also people are a bit more risk averse.
You look at 20 years of performance of all the companies listed on the stock market in New Zealand, how have they done over that time? 1 in 3 over that whole period gave investors a return of 0% to negative 100%. And the 75% performed below average. So picking a stock, statistically, the odds are against you. So you have a 3 in 4 chance you pick a stock that performs below average.
It's gambling.
Picking an individual stock is speculation, not.
That's nice. That's nice.
And so,
good caveat.
What we try and help people think about is what are the things that make good investing, and it's about being diversified, which is what index funds do for you, is keeping costs under control, and it's about you committing to doing it because. With investing and being exposed to the share market, particularly in those early years, it feels really slow.
Yeah.
When you put in 10,000 or 1,000 and it's just going up by small amounts, it takes some time. Like compounding and returns take time, but it's 5, 10, 20 years from now that you're going to be sitting on a much larger nest egg.
Yeah.
And it's helping people make sure they stick to that course and remain committed and patient. Because our own habits are our biggest sense of control.
Yeah, that's definitely the biggest opportunity, right? In terms of trying to get to that goal, do you see many people coming through to Kernel going, I'm going to use this to build a house deposit? Is that a conversation that you see?
Particularly with the Kiwisaver.
Yeah.
So our Kiwisaver has grown substantially over we've only had Kiwisaver sort of just over 2 years now. And we can see when people do first home withdrawal.
Yeah.
And just for context, I guess the median customer at Kernel is about 37, 38 years old. They've got 30 odd grand in investing. They may have 30, 40 grand built up to their Kiwisaver. They'll have some in their savings account with us as well. And so we very much see that the first home withdrawal for Kiwisaver, we also have a little pop-up question when people withdraw their whole balance because we want to know what's happened. And a lot of that is they've had a major purchase, so be it a house or some other event. But we do see people are now realizing that to keep ahead, they can't just build up their deposit or a house upgrade in a zero interest bank account. It still needs to be working for them.
No, they'll fall behind, in fact, with periods of inflation as they are. Yeah.
So we see that people are aware of that, putting their money to work and are flexible with when they want to buy, but it is very much a key stepstone to be able to maybe purchase that first home.
Yeah. What's your view on whether or not people should be making a high contribution to Kiwisaver versus actually just investing in stocks generally in an index fund, for example? Obviously, if they're doing it generally, they have access to those funds. If they're putting it in Kiwisaver, it's locked.
Yeah. So if you are planning for your first home, like obviously you're going to be able to get it out of Kiwisaver, so that may be something to think about. If you, and again, the other thing you'd really want to question, some employers will contribute more than 3%.
Yeah.
So if you have like some, I think doctors or others, like if you've got an employer that will match to 4% or 6% or 8%, you'd want to take that up because that's obviously much better to get that matching. Obviously, if there's no additional matching, then really you could do the exact same thing. You have the exact same fees and the exact same funds as a general investment or as a Kiwisaver. So you could do the exact same extra contribution into investing and have greater access. Where doing it through Kiwisaver may work for some people is those who may not have the best discipline. What Kiwisaver does is it forces you, by putting it in there, it's coming out of your paycheck before it even reaches your bank account. So for some people, if they've found that their savings and investing journey gets tripped up every now and then because they go and sell it to buy something else or they dip into those savings, they may find that actually by forcing themselves to do it, by taking it into Kiwisaver, it will create the discipline that maybe they wouldn't have otherwise.
Yeah. So perhaps if you're not necessarily disciplined or maybe you're just starting out and you're not actually that educated about managing your money, Kiwisaver is a good option. But if you are more mature in your financial experience, it might make sense to do your own thing rather than Kiwisaver, unless you're getting those contributions coming in. Because I actually don't contribute to Kiwisaver anymore, but at all.
For the $1,000?
No, I don't. But you got to think, my financial situation is very different. But I would say that I am well educated when it comes to what I'm doing with my funds. And I have long-term goals, short-term goals. I have 2 businesses, this being one. So any money that I put into here, I would, I have to back this business and its ability to 10x. So I'm moving all money into this business, as opposed to even government contributions, I don't think will make that difference when it comes to business ownership. But I also have already purchased my first home. So the next time I can use Kiwisaver is retirement.
I think this is, quite a big discussion point for Kiwisaver generally in New Zealand. I know the minister's looking at it because we've got, 250,000 SME businesses in New Zealand, right? We're a nation of small business owners. And as business owners,
you need cash flow as well.
And you're the employer giving the contribution, so you're paying yourself.
Yeah.
It's not the bonus like being an employee benefit. And I fully get that. And I think, though, that the government contribution, like for the average person out there, though, at the very least, that $1,000 and getting $500 a year, it's the only guaranteed 50% return you're going to get every year. And it may not be a significant amount, but if you do compound $1,500 a year over 20, 30 years, it will be an extra bonus in retirement. But it doesn't mean you have to do that every year, right? It may be that there are business owners out there who are really focused on the business right now.
I'm in the first 2 years of this business. So yes, I'll go back to Kiwisaver when, I have more cash flow and things look different. But right now, that's my biggest investment. It's an interesting conversation because everyone just thinks like you have to do it every year. But that's best practice, but there may be, if you're making other financial investments, there may be a case to say it might not be right at this period of time.
And I think for a lot of people, it's like everything. It's one of the nice things about what Kiwisaver and under investing does is that we do want to be diversified. So you've got 2 businesses. There'll be a lot of people who have one business and maybe no other assets. And it's got to be conscious to yourself of going, well, how do I also give some protection to myself that if this thing doesn't work or this strategy doesn't work or it doesn't get me as much as I thought in the future, what else have I got?
I think the way I see a business as well as shares and, because you'd invest in a business on the stock exchange, your own business is a version of that. And if anything, you have more control over it because you're the variable. You can work harder and hopefully see, the outcome 10x or, increase more than the confidence that you'd have in someone else's business. But I guess the answer is yes, Kiwisaver is optimal if you don't have much else going on, if you're working towards your first home and if you're working towards retirement. But if you're somewhere in between and you have other financial strategies, that's okay too.
I think what's going to be interesting to see is how they strike the balance with that flexibility going forward. Like there is a lot of talk now about reviewing our Kiwisaver settings. So if you look at the equivalent in Australia, the average Kiwisaver balance here, say 30 grand, the average in Australia is probably about 120,000. Now they've been going a lot longer than us, but their contribution rates are going up to 12% next year. So that's effectively twice our sort of 3 and 36% contribution. So there is a lot of talk that there will be a focus on actually at some point, New Zealand is going to have to start to increase the employer and individual contribution rates on Kiwisaver. They're going to look at the settings generally. Now, what we don't want is a lot of just constant tweaking because that gets,
hard to manage,
and people don't trust when they keep changing the rules, right? And there's got to be a balance that you enable flexibility because, again, should Kiwisaver be compulsory? That may be challenging for people on low income.
Well, that's what I'm thinking. I'm like, right now, imagine if they did that, everyone would be like, we can't afford we can't afford to live now, let alone live in the future.
So there's a whole bunch of challenges with this and trying to strike the right balance. And we want to help Kiwis build up their savings. But you have to be conscious that there is a spectrum of people at different stages of their life that need different flexibility.
Yeah. Let's dive into shares and property or shares versus property.
Right.
That's always the way that it's pitched. And I think it's really interesting. There's obviously benefits to each. Do you want to maybe start off by just sharing some of the benefits of shares and then I can counter with property?
So indexing investing is you're owning part of our economy. You're owning part of our productive economy, creating jobs, supporting employment. And basically, as a shareholder, you're benefiting from our collective innovation and the long-term economic growth of all of our businesses. Indexing enables you to do that really efficiently. You're just owning part of our long-term growth. So what we've seen is that as an asset class as a whole, you look over time, the highest performing asset class is shares. Next is property, then bonds, then cash. But obviously the big difference, which you'll highlight, is that with property,
Hey, don't take my arguments.
people can leverage.
Yeah.
So that's the fundamental difference, is that if you leveraged into shares, actually statistically you would have a better result.
But you can't borrow in New Zealand to do that.
You can with some platforms actually, but 50% sort of thing. So you can borrow 50%. But again, the challenge with it is shares change in value every day. And most of us would not be great logging in every day and seeing the value of their whole wealth going up and down so much every day. Yeah, I think we have a different view with property. But yeah, I think the key with property here is we've had a lot of focus on property, particularly since the 87 stock market crash in New Zealand. For a while there, like we just did not have regulations. There were a lot of dodgy shell companies being listed. There were a lot of people with famous sort of, investment banking names that made a lot of money out of poor mum and dads. But that has fundamentally changed. We now have a market that is as regulated and credible as any other major exchange now. So people are now more comfortable investing back into shares, which is great. And like the regulations around Kiwisaver funds fundamentally have changed over the past couple of decades. So I think there is confidence now for people to go, actually, shares is something, and being invested in the stock market is a safe, attractive long-term.
I guess Kiwisaver's almost enabled that to a degree, because it's like, hey, Kiwisaver's this government thing that we're all required to do. It's good for your savings, and then by the way, it is shares. So it's reintroducing that and making people comfortable with that. But I think that one of the biggest challenges, perhaps that you guys have to lean into is the education around shares. And I mean, obviously, we're seeing a great deal of that at the moment. So it's happening, and you guys are doing a great job. But I guess that's probably one of the biggest opportunities, because property is something that's reasonably well understood, I would say, in New Zealand, or at least trusted. And maybe there's the level of trust with shares probably isn't quite the same as with property yet.
Yeah, I do think that's rapidly changing.
Yeah.
The nice thing again about like what we do with Kernel and index funds is it's removing that sort of workload, and that when you buy a diversified index fund, you're not having to think about which stock do I buy. You're literally just being part of the market.
Yeah.
I think for property, one of the things I think we see is property is still quite challenging. Like there is actually a lot. What made property work so well, like many assets, but what was a big driver of property in New Zealand, and sort of almost any property did well, because what's happened is we've had basically 40 years of falling interest rates. So interest rates have fallen 40 years, have just been a great tailwind. Now, for the very first time in a generation, we've had interest rates really start to rise up, inflation that nobody's experienced since the 70s, right? So it slightly changes the game, where you do have to be a bit more conscious of the types of properties. It's not any property is just going to go up over time now. There'll be parts of the Auckland market and others that some of the banks saying, well, they won't be back to those peaks till 2029, 2030. And so that's a challenge now. I think there's going to be more complexity when it comes to property. Regulations are changing, deposit rates changing, deposit debt to income ratios, all these sort of different rules coming. So there's more complexity building into property now than previously.
Yeah, I definitely think that there are more changes, but over that 10-year period, we're still going to expect property to perform well. And I think it comes down to serviceability when you're looking at investing in property. Can you afford it? Can you afford to, maintain it and manage it over that period of time? If you can, you're generally going to get your money back and then some. And I think, what you mentioned about leverage is key, because if I had $10,000 today, or 20,000, let's say, and I put it into shares at 8%, sure, that might be a higher, return. But if I have $20,000 and I go on with friends, because we love co-ownership, it's nice as well, and then we purchase a property, we put in, then we leverage up, and it's 860,000 or whatever at 6%, we're still going to see a higher return because of the bank lending. I think the other thing is that one thing I remember struggling with is finding money to put in shares. So I obviously had Kiwisaver and I did dabble, but because all of my money was going towards rent.
Yeah.
So if my money's going towards rent, like the bulk amount of my money, and then I move that to property, then I'm also getting access to that money, which I couldn't put towards shares because I still need somewhere to live. So, if you're spending, I don't know, it could be 10,000 a year or whatever that you're spending on rent, and then you can move that towards your property, whereas you can't move that into shares.
We know that a lot of Kernel customers obviously build up their savings and investing with the aim of a first home, or maybe it is an investment property. We also know there's a lot of people who have made wealth in property and want to sell down one or two because they now want to have some more liquid investments and a bit of diversification because they want to be able to travel, they want a bit more accessible income, etc. So the role of the index funds and Kernel and savings, it can be really complementary. It can be a key part of a journey as well to building wealth and building into property. The average first-time buyer age is a lot older than what I think media and people think. I think there are a lot of 20-year-olds who feel like
it's 37, right?
Exactly.
Yeah.
And it's like, so it's a lot older than people, I think, perceive. And so that's a long time to think about, okay, saving up and just being comfortable. I've been renting in Auckland for 7 years now, and I've actually preferred renting because while I've been focusing on the business, that's a great lifestyle balance for me because the maintenance and other stresses and other costs and things that come on with being in a home, like think about your mortgage and changing mortgage rates, all those sort of things.
Yeah, I'm not going to lie. It adds stress for me having the business and properties to manage, where cash flow is important. But yeah, it depends on what your strategy is, right? And what you're able to do. But I think there's benefits to both, really. And it's not a one or other.
I definitely think increasingly, though, we're wanting to see people have an allocation rather than it just being the Kiwi way of only property. And there's two reasons. One is property can build wealth, but it also doesn't help productivity. But
this, I feel, is the best argument. I'd love to dive into that more.
Because it doesn't, by buying shares in businesses, that creates jobs. The second piece that I think people are becoming, the insurance companies are becoming more conscious of, and I think Kiwis are becoming more conscious of, is the challenges of property diversification. A lot of Kiwis typically have 1, 2, 3 investment properties, and they'll typically be within a similar region, right? And that increasingly has risk. So by diversifying, and not saying not have to property, but by having some shares, and through an index fund, you can own 1,000 companies across the globe. That helps balance out some of that risk of only having your wealth, you take
in one region, say you've bought 3 properties in Auckland, but ideally you wouldn't do that, but some do.
A lot of people do, right? And a lot of people would have seen this in Hawke's Bay and seen the damage that can come in. And we are naturally going to experience more natural disasters. We are a shaky little island at the bottom of the world, prone to lovely media articles that play out about tsunamis and earthquakes down the...
We're number 2, I think, in terms of risk for insurance.
The nice thing about having a mix of assets is it will give you some protection for those moments that could be unexpected, but probable. So
yeah, definitely. And I think they're happening more and more in New Zealand. We, as you say, and it's not going to get...
companies obviously seeing it, right?
The premiums have definitely spiked, and I think they'll continue to do so. If you are looking at buying a property, it's really important to look at insurance and the cost of that, but also actually whether or not it's likely to be insurable in future, because just because they insure it for you doesn't mean that when you go to sell in 5-10 years and it's, obviously got a bunch of problems because you bought cliff facing and it's sliding or something like that. You want to be thinking, actually, how robust is this investment?
My mum's partner they were living in Spring Creek in Blenheim behind the stock bank, and they've sold because they had a couple of major rainfall events where the water got to within centimeters of being at that bank level, and was just looking at going, at some point, this is just not going to be insurable. And
if it could be 10 years, 15 years away, but you don't want to be left with a hot potato.
Yeah, because at that point, that value of that asset changes substantially because the potential for other buyers is really limited, because if you can't get insurance, you won't be able to get a mortgage.
As much as I obviously love property, I love that property can provide financial independence and it gives people options. So that's why I'm passionate about it. From an economic perspective, I'm torn. So I'm positive on like capital gains tax, for example. Yet I own a couple of properties, but I have these conflicting views. Like, I believe that everyone should have access to property. However, I enjoy it when my properties increase in value. So it's like, but I would, if I had to choose, I would prefer to provide access, hence why Slice exists, why I'm pro capital gains tax. We have these conflicting views. And I think one of the biggest ones is actually what you've brought up, which is, hang on, if we invest in businesses as a country, we perform better, NZ GDP improves, cost of living, all of those challenges are far easier to manage, and unemployment drops. Basically New Zealand does better if we invest in businesses, but we just love property. Then there's that, broader sense of actually how can we give back, how can we innovate, how can we grow things? And so I am conflicted when it comes to things like that. I would love to see more building of properties, more. The government has tried to incentivize, new builds and things like that, but I think there's still a lot of work to be done in that space because there's regulation that's hampering that. And I think that would make more sense if we, actively we're growing the properties available, because we're getting 110,000, 120,000 migrants coming in, and we don't have enough houses for everyone. So
quality housing.
Yeah, quality housing. It would be great if we invested more into property as opposed to had individual players speculating in the space. But, it isn't any one person's fault. I think it's the system that's not functioning. And
again, it does come back to the system, and it's really interesting because if you look at the banking system as a whole, not an individual bank, but the system and how risk gets calculated, in terms of the amount of capital they have to have sitting aside for the amount that they lend out, property is viewed, obviously, and arguably right, but property is much less risky in their risk assessments than lending to a business. So they are skewed and biased and want to lend more to property, unfortunately, than lending to businesses to start a business or for a farmer to buy a tractor and to create productivity. And
they've given me 1.2 million lending for my properties, but they've given me nothing for my business.
But this is the thing. So the system as a whole was actually geared towards property, which is really sad because that just fuels easier money and access to,
adds gasoline on the fire. And without, direction of those funds, it's just giving it to the individual player instead of to some, systemic solution that could be, okay, we're actually going to encourage lending only on new builds, or, I don't know what the answer is, but there are many possible solutions, and it's a challenge that we're not going to solve in one day. But obviously Slice is trying to provide access to property, but also we are trying to kind of encourage the right behaviors as well at the macro level. And I think that diversified portfolio approach, you're dead on. I think that's the ultimate goal for anyone listening. I hope that you take that away, that you can use shares to get into property, you can buy a property now, do shares later. It's a mixture of kind of approaches for where you're at in your life stage, I suppose.
Exactly.
And if you're a bank listening, maybe you should fund our businesses. If your first home had a doorbell and that doorbell played a theme song, what song would it play, Dean? Oh, MJ. We haven't had anyone choose MJ yet. That's a great choice.
There we go. That was the Spotify DJ. That gives you an insight as to maybe what goes through the beats.
I love that. Thanks, Dean.
Thank you.
Thank you for joining our community. Buying property isn't easy, but listening in will get you one step closer on your journey. Please leave an Apple or Spotify review and provide feedback so we can improve your experience. Join our Facebook group, A Safe Space to Learn Together, or follow us on Instagram at Slice2Buy. If you have any questions or topics you would like us to touch on, you can email us at hello@slice2buy.com. A quick reminder, Slice the podcast does not provide personalised investment advice. We are not acting as financial advisors or taking into account your circumstances. To get personalised advice, join us at slice2buy.com and engage with our partners who can act as your financial advisor or lawyer and support you with your specific needs.